Very positive. We are at an inflection point because you look in the numbers, you'll see that we continued to do some restructuring in Q3. So we weren't done. We closed some of our macro businesses and we moved to London some of our emerging market businesses. All that cost us about 6-7% of growth. So if you take that out, actually equities is up 6%, which is really a big news for us because this is an area where we want to grow and we want to do more. And it's the first time that we see such a positive movement. And fixed income is down 15%, which is in line considering what's happened in SP. But look, the point is really looking forward. You have to realize this business has seen more than 1.5 billion of cost reduction and has been in constant restructuring for 3 years. So we're looking forward to 19 because it will be their first year without restructuring. We can be on the phone, serve our clients without having to fear another wave of changes. And we're going to get a windfall from paying down the COCOs. Okay? The funding for global market has been expensive. It's going to be going down by 250 million at least. So that's a 250 million additional profit for global market. So we're now confident that in 19, global market is the last division that will move towards the profitability level we aimed at.
But let's just talk a little bit about the operating environment that you'll live in. I mean, back early in October, you told a conference in Paris, we're nervous about markets. There is a fragile equilibrium. Do you anticipate that fragility will now continue into 2019? And what will be the consequences of that?
It's a difficult environment. Let's start with the economy. The economy is doing very well. I think everybody sees that. The growth rates are solid. The IMF went down a little bit in its forecast, but it's fine. So everybody sees that. But there is a disconnect between the condition of the economy, if you wish, and the psychology, the mindset in markets, which is a bit fragile, as I said. People feel that equity market valuations are high, so they are very hesitant to come in. They feel that interest rates are going to go up. So fixed income feels risky. And you see a kind of bear market. What you see in a bear market is that you see big volumes when the market goes down and small volumes when the market goes up. And that's kind of what you're feeling now. So that nervousness comes through the numbers. And then I think the surprises, the geopolitical uncertainty, the issues on trade, all that creates a difficult climate. So we are cautious, which is why it goes back to our whole strategy, which has been to de-emphasize the more volatile parts of our activity. Jeff, I can tell you, in a quarter like this, the old Credit Suisse would have lost hundreds of millions. And that's easy to demonstrate. Today we're making a profit, 850 million. That's because we de-risked massively. We'll give the numbers this morning, but we cut our inventories anywhere between 40 to 60% in all our fixed income portfolio. We de-risk massively. We have less risk, a stronger, more capital, a stronger balance sheet, and we got rid of our legacy. All the RMBS and all those issues are done. So we're coming into this environment with a kind of clean balance sheet, solid capital, low risk, and actually, personally, I don't mind because I think there are also opportunities in those times, opportunities to serve our clients. And if you look at what we've done in IBCM, we took a very specific model by making Asia a division and separating it from the US and from Europe. Well, that has allowed us to grow faster than any other bank since 2015. We're 31% up. We're number 2 now in Asia. We're number 1 in Switzerland. We're number 4 or 5 in the US. So it has worked and it has given us huge strength. So we see those times as times where if you play your cards right, there are opportunities.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.